Better. Good evening. My name is Jesse Blauw. I am an advisor with Equitable. So I just wanted to take a couple minutes in your packet. You should have an agenda. So just wanted to take a couple minutes to introduce myself, introduce my business, and then there's a couple of topics we're going to cover: qualified retirement account options, just the basics, the importance of allocations, life insurance basics, creating a retirement plan, and then I'll make sure and have some time for questions. So to start out, you guys are probably wondering, who is this gentleman in front of you? My name is Jesse. I was born and raised right here in Kalamazoo. I was homeschooled all the way up until my senior year, and then I went to Kalamazoo Public Schools for my senior year. I then went on to Western Michigan University. I am a WMU grad. I got my bachelor's in business management with minors in general business and economics. If my voice cracks during this time, I just came from church camp. From Monday to Thursday, I was in charge of games. So I was doing quite a bit of yelling and getting yelled at by 150 middle schoolers. So I'm happy to be here. Thank you to Saeed for inviting me. It's a pleasure to be here. A little bit more about me. Family is very important. I'm one of four. I have 3 siblings, 2 older sisters, a younger brother. I do have a wife. We don't have any of our own children yet. However, we do have legal guardianship of my niece. We've had her since she was 12. She now just turned 15, so going on 3 years with her. Love her just like a daughter. She is being homeschooled by my wife, and the plan is to begin trying for our own children sometime later this year. Business-wise, a lot of people say Equitable. Jesse, I've never heard of Equitable. Who is Equitable? If you have, open up your packet, there is a handout, looks like this. If you turn to page 2, just gives a couple of pieces of information. We have been around for just over 160 years, so a very old company. We do have just over $210 billion in assets under management, just over 2.8 million clients, and more than 4,300 advisors like myself who meet with people to educate them on the availability of retirement accounts to them, their other benefits, whether it's through their work or setting it up personally, and just to answer questions about retirement savings and financials in general. If you move again, or turn the page to page number 4, one of the things we like to do as a firm is you have kind of a common approach, and then you have what we call the Equitable Advisors approach. So common approach is, throughout the years, a lot of times people kind of open up an account here, an account there. Maybe they get insurance from here, insurance from another financial firm. So they have this broad array of products, which then creates a portfolio for them. And then lastly comes in strategy at the bottom. Here at Equitable, what we like to do is we like to have strategy be the foundation of your overall financial housing, I should say. From that, we create a portfolio, and then once we know what we want portfolio-wise, we go to the market and find some products to accomplish what you're wanting to accomplish. So main thing is, we've been around for a while. We don't spend a lot of money on advertising just because we're so large. A lot of my own personal business, I've been with Equitable for just over 11 years now. Most of the people that I started with, or at least a few of them, are still with me, and I think that's part of the reason why I've been with them for so long, is I get along well with my fellow advisors. We've been working together for quite a while now, so they've almost become a part of my extended family. It's not just me that I work with clients. I have fellow advisors that have been in the business anywhere from 18 to up to 45 years of experience. That is the gentleman who technically hired me in. He enjoys what he does. I know his wife wants him to retire, but he just enjoys working with people, and so he's going to be continuing on. I enjoy what I do, and mainly in my business, when I first started, I was working with a lot of educators in the schools. It's called the RBG, the Retirement Benefits Group. So I worked with anybody from a parapro who gets paid hourly all the way up to superintendent of the schools. Over the last decade, I've kind of evolved. My business has evolved to now I work with a lot of individuals outside of the schools. How did that come to be? Well, a lot of educators have either husbands or wives or cousins or brothers who work outside of the schools. They have questions as well. And so referral business is a large part of my business. People giving warm introductions of, hey, you've been helping me. Can you help my brother? He just left employment. He has a 401k. Can you help him with some options for that? The answer is absolutely. Okay, so enjoy being with Equitable. Plan on being here for the foreseeable future. The first thing I'd like to go over is qualified retirement account options. You should have a notes page. Feel free to take notes. And then you should have this other handout. It's called 2025 Key Financial Numbers. So if you'll pull that out, at the very front of it, it just gives a basic overview of federal income taxes. It's a structured system. So for somebody who's a single filer, the first roughly $12,000 that you make, you get taxed at 10%. Anything from $12,000 up to just over 48,400 gets taxed at 12%. So the more money you make, the more money, the bigger a piece the federal government is going to take from those wages. So a large part of what I do is help individuals either limit what they're paying in taxes, if they're up in a higher tax bracket, or help them save money for retirement by utilizing something available through them, whether that is a 401k, which is an employer-sponsored plan. If you work in the private sector, if you work in the nonprofit sector, that might look like a 403b or a 457. So depending on what sector of business you're working in, whether it's private or not-for-profit, it could look a little bit differently. But either way, those accounts are designed to lower your taxable income. And that just means that whatever we put into those accounts today, it lowers our taxable income for the year, meaning we pay less in taxes. And then in retirement, when we start pulling those monies out for income, that's when we pay our taxes to our government, okay? Sometimes, and if you turn to page, it looks like it's going to be page 3, midway down it says retirement plan contributions and then lists the different types of retirement plans. If you work for a company, there's a good chance that they have a 401k available to you. Whether or not you utilize that 401k is a lot of times up to you, right? So number one question is, do I have access to an employer-sponsored plan, whether that's a 401k, a 403b? The follow-up question is, do they have any type of employer match? And the reason I mention that is, a lot of times companies will match a contribution that you're making, and it's essentially free money for you. It's not uncommon to sit down with somebody, they have a 401k, maybe they're contributing 2% to it, and they don't realize that if they contribute an extra 1 or 2%, the employer would be giving them an additional match of 1 or 2%. They just didn't realize it. So it's making sure you understand what are my employer's benefits if they don't have a 401k plan or a 403b plan, 457 plan. You have the option of opening up what's called an IRA. That is an individual retirement account. That is something anybody can open up as long as you have taxable income, okay? So if there's no employer-sponsored plan, it's not the end of the world. You still have access to what's called an IRA. The contribution limit is just going to be a lot lower than what an employer-sponsored plan is. So for this year, 2025, an employer-sponsored plan is $23,500. For somebody who is age 50 or above, that jumps an extra $7,500 for a total of $31,000 that the government is going to let them put into or contribute to their 401k, 403b, or 457 plan. Very high contribution limit. Doesn't mean you have to contribute that much. We can just contribute up to $31,000 or any amount below. This year now, for people ages 60 to 63, there's an additional catch-up contribution, so you can contribute up to $34,750 for those 3 years. Once again, it's the government saying, hey, we're going to let you put a few extra dollars away towards retirement, lower your taxable income, since you're getting close to being able to be fully retired. And then when you draw those retirement funds out of your 401k, you're going to have to pay your taxes. The flip side of that, if it's not pre-tax, sometimes an employer-sponsored plan has what's called the Roth option. Roth just means that we're going to pay our taxes today. We're going to put them into that account. They're going to grow compound interest, whatever they're invested in. And when we pull them out, now we don't owe the government anything. Why? Because we already gave them their piece at the beginning. So Roth contributions can be a huge benefit because we're paying our taxes today, and then when we pull it out in retirement, now we don't owe the government anything. For a lot of people, those Roth savings are probably going to be the last piece you touch in retirement just because they're essentially growing tax-free. Does that make sense? So for a 403B, a 401k, a 457, 23,500, if you don't have access to any of those and you open your own IRA, the contribution limit is 7,000. You notice that about a little over halfway down. And then you have a catch-up provision after 50 plus of an additional 1,000, so you can still put up to $8,000 away into a retirement account. Question I get asked, okay, Jesse, I want an IRA. Who do I talk to? That's what I'm here for. So if you guys have questions after the meeting, you say, hey, I'm interested in potentially opening up an IRA, I have questions, or I have a 401k that I have some questions about, that's what I'm here for, is to make myself available to answer any questions that you guys have about financials, okay? So am I currently saving for retirement is a big question, and if I am I saving enough? And if not, why not? Is there a reason that I'm not saving for retirement? You don't have to do it pre-tax, meaning it doesn't have to come off of your taxable base. If we open up what's called a Roth IRA, which is an IRA just after tax, or Roth dollars, once again, we can pay the government today and never have to pay them again down the road, okay? One thing I've learned from doing this is that time often goes fast. I remember when I first started with the company, going on roughly 11 years ago, and I thought, man, I wonder what life's gonna look like in 10 years, and now here I am standing talking about it, right? So a question I get asked is, Jesse, is there at any point in time, is it just too late to start saving for retirement? The answer is no. There are still going to be benefits to saving for retirement. If we want to sit down at some point and just go over those benefits of how could putting extra money away benefit me, Jesse, more than happy to do that with you, okay? So moving on, that was qualified retirement accounts. If you guys have further questions, feel free to answer. Do you guys have any specific questions on any of what I just covered? Yes.
So I believe the options you covered just for people who are employed by an employer.
Yes. Self-employed people, perfect question. You're always going to be able to utilize an IRA, but there are other retirement accounts that might be advantageous to you as well, depending on what your business looks like, how you're taking your income. Do you have employees that have been with you for a while? Do you just have part-time employees? So based on some of those factors, if you look down listed a little bit farther down, you'll see is listed a simple IRA. That could be a good option for you. We also have what's called a SEP IRA. Contribution limit for that is going to be the lesser of $70,000 or 25% of your pay. So for somebody who is earning $100,000, just for a nice round number, they could put up to $25,000 away every year if they wanted to. For somebody who's making, let's just say on the high side, $400,000, they're going to be allowed to put up to $70,000 away into that SEP IRA and defer their taxable income by up to $70,000. So those could be very key pieces for you guys as well. And that's where it comes back to, okay, let's set a time to sit down and just see, what does your business look like? You know, what do you have employees that you want to potentially offer a benefit to? Is it more based around you yourself and just saving for retirement for yourself? Or are there people that have been working with you that you'd like to help compensate by having maybe an additional match? Sometimes that can help people stick around longer, can make employees a little bit more sticky because they have a reason to stay with you. You're giving them an extra piece towards retirement as long as they're contributing as well. So that could be, as an employer, as a business owner, that could be a huge piece to add to your overall business as well. Love to go over that. Great question. Any other questions on retirement accounts? Once again, go ahead.
What's Medicare?
So Medicare is once you turn 65 in the States, you go off private insurance and on to what's called Medicare. And so they're going to cover your medical expenses from 65 on. Typically, if you're still working, that becomes a supplemental plan. So instead of paying for a full health insurance plan, you would then, that becomes supplemental to Medicare. And if you are still working to defer what's called Part B, when you turn 65, you have to go into the Social Security's website, let them know that I'm still working for an employer, I'm still covered, I don't need Medicare Part B. You defer that until you end employment with whoever you're employed by, and then Medicare Part B will kick in for you as well.
If you are already on Medicare A and B,
Yes.
what's this table here, like single head of household income, 200,000 and stuff like that?
Which one are you looking at?
Page 7, Medicare investment income.
Let me scoot ahead here. So that's basically what, while you're employed, what the employer is paying in to Medicare for each of their employees, and what their employee, or if you're self-employed, is paying in towards Medicare. That's what's coming out of your paycheck towards that. Does that make sense? So there's a lot that goes into employer-sponsored plans. There's a lot of options out there. And really what it comes down to is your particular situation and figuring out what is going to be most advantageous for you. Is it going to be just opening an IRA? Do you have access to an employer-sponsored plan like a 401k? Or do we need to look into something like a SEP IRA or a simple IRA to accomplish what you want to accomplish in your business?
So like he asked, if you are a single self-employed,
Yes,
so I should open a simple IRA,
potentially.
and what's the 16,000 to 17,000 each? That's tax deferred, or?
Yes,
So you don't pay
exactly.
taxes on
So you're lowering your taxable income. Yes. So that could be a good fit for you, or maybe it makes more sense to look into opening a SEP IRA instead, and there could be different reasons. It's real easy to get into the weeds because everybody's in a different boat financially, so what makes sense for you might not make sense for the person next to you. So that's where it makes most sense to schedule a time to just sit down and see specifically what's going to be most beneficial for you in terms of what retirement account to open.
Because traditional account, the max you can invest is 7,000.
Correct.
So if he's making 60,000, it's not good.
We can defer 7,000 of it, and then if he needs more above and beyond that, we can look at other ways potentially. So there's a lot of different options in terms, this is just qualified plans, but there are other ways to defer and or save for retirement utilizing other investment vehicles, and that's something that we could definitely cover if you had questions about as well.
Can you do both traditional and the simple IRA?
Typically, I believe so, yes.
So you can put 17,000 and 7,000.
Yeah. So that would be, we would just want to cover that at some point together and see what makes most sense for you. Okay. Farther on, if you look, there is for a Roth IRA, because I get a lot of questions about Roth IRAs. Is there a phase out? The answer is yes. If you make too much money, the federal government tells you, hey, you're no longer allowed to contribute to a Roth IRA. Your income is too high. In that case, sometimes we can do what is called a backdoor Roth, which all that is contributing to a traditional IRA, which is pre-tax money, and then converting that later on into Roth contributions, so paying your taxes on it. Not going to get into specifically how that works, but if you're in that boat and you're curious and want to go over some of those options, more than happy to do that with you as well.
So if you go like traditional,
Yes.
401k, you pay taxes on it, and then you put it in a Roth IRA.
Correct. And now it's already taxed income, it's in a Roth vehicle, and when you get to retirement and you pull that money out, you're going to pay the government zero taxes on it.
Before it goes into Roth, it's considered income I have to file at the end of the year.
No, it's considered pre-tax income. But when we convert it, it becomes taxable income.
We already pay tax. Like if I took 100,000 from my 401k,
Yes,
I pay it to 22%, for example.
yes. Now that's after-tax income.
So now I have after-tax income
Yes.
that I can put into a Roth IRA.
So you would Technically, yes, but that would count as what you would be putting into your Roth IRA would be earned income for that year.
Right.
So if you weren't working, you had zero earned income, and you just converted that, took that 100,000 out of your traditional 401k, right? We can't contribute to a Roth IRA because that has to be earned income. What you've just done, right? So it's taxable because you're pulling it out of a 401k, but there are other options that we can potentially utilize. Once again, maybe it's not in the form of a Roth IRA, maybe it's in the form of a life insurance policy or by other means.
My concern is it gonna be at the end of the year, an income that I have to file on my 1040?
Gotcha. I know this is a cop-out answer, but let's sit down because I don't want to tell you something without seeing everything and tell you that yes, or yes, this is going to be the case, and then have it not be, because that wouldn't be fair to you. Does that make sense? Okay. How are we doing on time? We're doing all right? Okay, let's talk about allocations. This gets skimmed over sometimes. So if we do have a current 401k maybe that you've put money into, maybe you have an IRA, some type of investment sitting out there, a lot of times, I should say many times, when you start contributing to a 401k, unless you choose otherwise, that is going into what's called a target date fund. And all a target date fund is designed to do is be more aggressive early on, and then as you get closer to that retirement date, so for example, let's take an individual who's in a target date 2050 fund. That means as we get closer to the year 2050, each year we get closer, it gets a little more and a little more conservative. Starts out aggressive, mainly invested in stocks, equities. As we get closer and closer to that retirement date, they start converting that into probably bond funds, and eventually we're at either a 70-30 or 80-20 bond fund. Well, the problem is maybe we're not ready to take that as income. Maybe we're not planning on touching that money for another 10 years. Well, why would we want to be primarily in bonds and not earning interest in the market versus being more aggressive? So allocation can become a very important piece, is making sure that whatever our investment assets are, that they're allocated correctly so that they're doing exactly what we want them to do, and earning us a return while we're still not retired, so that when we are retired, we have enough to draw off of. So in terms of allocations, the question would be, have I reviewed my allocations with somebody? Or do I just know that they're sitting there and they've been, maybe they've been doing really well, maybe they've been doing not so great, but what are my current goals? Am I getting close to that full retirement date where I'm gonna potentially be pulling money out? Or do I still have quite a bit of time on my side? Well, we should probably review and make sure that if they are sitting in a 401k, that they're doing what they should be doing for you. And also, if it's still attached to a former employer, maybe it's an old 401k from a different job, maybe we want to take those contributions and move them to an IRA. So then the question is, well, Jesse, why would I do that? Typical answer is, in a 401k plan, it's usually pretty limited in your investment options. So maybe it's through Fidelity, they'll have a handful of large cap funds, some mid cap, small cap, some bond funds, and then target date funds. In an IRA, we can pick and choose whatever you want to invest in versus only utilizing that specific list of funds, right? So as long as you've either separated employment or you're over the age of 59 and a half and they allow in-service withdrawals, we can potentially move those monies out of that plan into your own personal IRA, where now you can more actively manage it and choose where you're investing versus just using their investment options. So that could be a good goal, and it all comes down to what are we concerned with? Are we concerned of safety of principal? Are we worried that if the market drops 20+%, that we're going to see a large part of our investments, savings disappear, or that they'll drop and we're going to need to pull out at that point and sell at a low? Well, then maybe we want to look at moving it into an IRA. And once again, how is my money working for me? Could I do better? Am I seeing low returns while the market, the S&P 500, seems to be going up, and yet my retirement account is just kind of creeping along? Maybe we need to be reallocated. Another question is, for non-retirement money, what I found is a lot of people are in this situation where they've been putting money away. Maybe it's not into a retirement account, maybe it's just into some type of interest-bearing account, or it's just sitting at the bank, maybe it's in a money market account, maybe it's just sitting there earning nothing. I had a client one time, I sat down with her, and she had over $250,000 sitting at the bank. And my question to her was, why? And her answer was, it's just what I've always done. Every time she gets paid, a piece of her paycheck has always gone to that account, and it's just sat there. It's not earning anything. They're giving her maybe 0.25% in interest, sitting in this checking/savings account. So the question was why? Her answer was, I've just always done it. And so I followed up with, well, when are you realistically going to need to use those monies? Are you saving for a specific purchase? Are you saving for a home? Are you saving for a car? Is there another big purchase? And she said, no. Honestly, there's no big purchases on my horizon. It's just what I've always done. So then it was, well, let's bring some other options to the table. What could we do instead of just putting it in the bank? Where could we potentially invest it where you're actually going to see a return and grow that money versus it just sitting there, getting slowly added to, right? So sometimes it's by no fault of our own. This is what we've always done. We didn't realize there were other options for us. My job is to bring those options to the table, and if one of them feels right, sounds right, and you're comfortable with it and want to move forward, if I can be the one to help you do that, then that's what I'm here for, right? So that's a lot of times in reviewing allocations is figuring out where is my money sitting, whether it's in a retirement account, if it's in non-qualified accounts, is it sitting in cash? Maybe we're not going to move the whole thing, maybe we just take a piece. Maybe there's a large chunk sitting somewhere and we want to take a piece of that and put it somewhere else so that we can actually earn something on it and save better for retirement. That would probably be beneficial, once again. Okay. I get a lot of questions about life insurance, and this is another piece that's in your, if you didn't get one of those, there should be in the back that you can grab. So here are the typical questions in terms of life insurance. Number one, do I have any? A lot of times employers provide, yes? Yes, go for it.
The thing is just with these kind of ways to invest.
Yes.
What if I die? Can my family take it out? Because
Good question.
in the situation,
Yes.
the 401k is almost gone because somebody died. Oh yeah, 401k is gone.
Okay.
Something like that.
Yeah. So if you were to pass away, typically you're going to have a beneficiary attached to those accounts. So there are rules in terms of when they can take that out and how long they can keep it in there. And it's typically going to be like if it's sitting in a Roth IRA, they would inherit that account, but then the government wants them to liquidate that account within 10 years. So they can let it sit there for, 3.5 years, but then they're going to have to take the whole amount and liquidate it because the government doesn't want it just sitting there indefinitely earning untaxed interest, right? So from the government standpoint, it's, hey, we're going to let somebody else inherit this, but they're going to have to withdraw it at some point. They can use it for whatever they want. They can turn around and put it back into their own Roth IRA as long as they have taxable income, right? So they're just going to have to use it, but they will have a beneficiary attached to that. Does that answer your question? Yeah.
Yeah, but what he's saying is they couldn't take it, but usually 401k, if you're working for an employer,
Yes.
like you said, they have beneficiaries on.
Yes.
There is no limit. If I die at age 40, it doesn't matter. The beneficiaries get the money. They don't have to be 62 or 65.
So let me make sure I'm hearing this question correctly. You're saying when does the beneficiary take ownership of that money?
At death, like if the
Yeah.
employee dies,
Yes.
then the beneficiary has the right to the money.
Yes.
I don't think the government gives them, like, you can't take it now because you are under 57 or whatever.
Yes.
They can take it, it's cash money to them now.
Yes.
He's saying they couldn't get it.
What about the 401k? So the 401k, can I take that because let's say my father died, he had a 401k, can I take that?
You're a beneficiary, that's what I mean.
Even if I'm a beneficiary, I don't know if I could take the 401k. Roth IRA, probably, but the 401k, I think you would lose it.
The 401k is still going to be your money. You're not going to just lose it. The government isn't going to just take it. If that's what I feel like that question is going towards is it just going to disappear because of my age? Or the answer is no. The government isn't just going to decide father passed away and now we're just going to take this money, right? That's not going to happen. It's still going to be given to you. It's just there's different circumstances determining whether you're going to be able to take that money right away as income or if it's going to have to stay in some type of qualified account until you're of age, etc. So hopefully that kind of answers your question. The hard part about finance is there's a lot of different stipulations of when you can take it and when not to, and if you have to take it, and when that money would have to be withdrawn from, depending on where it's sitting. So it kind of comes down to an individual basis, but for the most part, no, the government isn't just going to take that money and say, too bad, it's ours now. It's still going to be yours if you were beneficiary. Does that make sense?
Yes.
Okay. Does it answer your question too?
Yeah, but they told me that if I die, the 401k goes to the beneficiary.
Yeah,
It doesn't go to the government like you said.
correct.
But they don't have an age, unless they are minor,
Right.
it becomes an issue.
Yes.
If they are adults, no,
Probably because it's pre-tax.
right.
Yes.
Distributed, but they have to pay taxes on it because it's.
But you were saying that there was a situation where somebody didn't get the 401k.
That's what I thought he's saying, that
Gotcha.
The government no, doesn't.
Okay. Yes.
So,
Yeah.
can you go over the like annuity versus lump sum?
Say that one more time.
Can you go over over the annuity versus lump sum?
So taking an annuity payment versus a lump sum payment, where is that? It's really determined where is that coming from.
Like after retirement, because like from let's say 401k,
Okay.
you have the option to take like lump sums and also you have the option.
Potentially annuitize it? Yes. So that really comes down to what are you concerned with not having enough money in retirement? Right? So if money is going to be a concern of I don't know if my current money is going to last, by annuitizing something, it's just guaranteed a payment for life. Right? That payment is typically going to be lower, or you can take the lump sum and invest it however you'd like, but now it's on you. If you run through that money and it runs out, then you're out of money. With an annuity, you're saying, I'm willing to give you a lump sum and then receive a guaranteed payment for the rest of my life. Does that make sense?
Yeah, it does, but how like tax-wise?
Yeah.
How does that tax-wise?
Tax-wise, if you take it as a lump sum and it moves into a qualified account like an IRA, we're not paying any taxes on it. If you take it as income, we'll now have to pay full taxes on it, and depending on how large that income is, could be paying a large percentage in taxes. So if you are wanting to take it as a lump sum, that's where it's figuring out, okay, where would a good landing place for this lump sum be so that I don't get absolutely killed in taxes and lose out on a large portion of my money? Then I can slowly take it out as I desire. Does that make sense?
From what I understood, he's trying to say, like, if he takes money from his 401k
Yeah.
to put it into annuity.
Yes.
You know, like I did.
Yes.
I closed the 401k and moved all the money to annuity.
Yes.
I didn't pay any taxes.
Correct.
Moved.
And the reason you didn't pay any,
Touch
yeah,
it, then I have to pay taxes.
yes. So the reason you didn't pay anything is what you're doing is you're taking it from one qualified account, which was a 401k, and moving it to another qualified account, which is an IRA. It's an annuity IRA, right?
Fixed annuity.
Or fixed annuity. Yes. Still a qualified account where now we're taking, a guaranteed payment from it over time instead of taking it as a lump sum. So it's all, whether we pay taxes on it, it's kind of all determined on where we're moving that money to. Is it coming to us as income, or are we moving it over to another qualified account? And that's where working with somebody, if not me, just somebody in the financial field of, telling them what are your concerns, what are your desires, what are your needs, and making sure we don't do something that we don't want to do and suddenly have a very large tax burden that we have to pay. Does that make sense?
We're trying not to pay that.
Exactly.
Anyway, we
You get taxed a lot in this country, right? You get taxed coming and going. So, yes, two guarantees in life, death and taxes, absolutely. So anytime we can minimize how big a piece we're paying in taxes, that's going to be super beneficial, okay? So, got to make sure I get out of here on time. Respect your time. Life insurance. Once again, I'm just trying to plant seeds, things to be thinking about. And if you guys want to sit down and actually run some scenarios, that's what I'm here for, okay? In terms of life insurance, typical question I get asked, Jesse, why would I ever have life insurance? What is life insurance for? Life insurance is to protect your loved ones. The main reason being, heaven forbid something happened to me last Tuesday. I would want to make sure that my wife and my niece are both taken care of. Right now, my income is the main income for our household. Okay, my wife works with me. She's my executive assistant, so technically her income is part of mine as well. But if something were to happen to me, she's either got to go out and find a different job to pay the bills, probably multiple jobs. And really for me, it's, well, what's important to me? Them being taken care of is most important to me. I want to make sure that it's hard enough to lose a loved one, but also then to have this burden of income and money, which is a tool, not having enough of it, is a big deal. So for me, term insurance, there's really two main types of insurance, and you have a handout in your thing. It just says the 5 types of life insurance. So piece number 1 is just term insurance. The way term insurance works is you say, hey, I want, let's just say for around $100,000 in coverage. Maybe that seems low, maybe it seems high. Let's say $1 million in coverage. As long as you're going to go through the underwriting process, the life insurance company is going to give you a rating based on how risky they feel you are in terms health-wise. Somebody who has health conditions, technically more risky to insure than somebody who's super healthy, runs every day, eats healthy, etc. Right? So they're going to do an underwriting process, give you a rating, and then based off that rating, you get to choose to accept the life insurance policy or to deny the life insurance policy. That's up to you. If you accept it, as long as you pay that premium for the term of the contract, that life insurance remains in place. Okay? So if it's $1 million life insurance policy, and let's just say it's $200 a month, if you pay $200 a month, as long as you pay that premium, from now until 20 years from now, if anything happens to you, you pass away, the life insurance company is going to pay whoever your beneficiary is a tax-free lump sum. Okay? If you die within that 20-year term, so I'll just use 20 years as an example. Term insurance is usually 10, 15, 20, sometimes 30 years. So all you're saying is, I'm ensuring that if anything happens to me between now and 20 years from now, somebody is going to get a check from the life insurance company. If you don't die after 20 years, the life insurance policy stops and you're no longer insured. So the question that I typically get asked is, Jesse, why would I utilize life insurance if I'm not getting anything out of it? Exactly. So the answer to that is just like car insurance. If I go and buy a very nice car at the car dealership, if I put full coverage on it, I know that if I get in an accident or if some yahoo blows through a red light and T-bones me in the middle of an intersection and totals my car, I'm going to get that car replaced. If after 20 years nobody hits my car, I still paid full coverage on it, right? But I don't get any of those premiums back typically. It's just the worst case scenario. It's the same with life insurance. Life insurance is worst case scenario. What is worst case scenario in Jesse's life? It's that I'm not here anymore, right? If I'm not here anymore, I'm not here to protect my wife and niece. I'm not here to provide for my wife and niece. I'm not here to make memories with my wife and niece. It's just a way to leave that tool of money to my beneficiaries to make sure that their bills are paid. That if my niece wants to go to college, she's able to pay for higher education. That if I want to, and it comes down to me in realistically figuring out And that's kind of a question I get asked is, well, how do I figure out how much I should have in life insurance? There's really two main ways. You take your income, multiply it by 10, some people say 12, that should be how much you have in life insurance. That's the easy way. The way I like to do it is listing out, if I'm not here, if something happened last Tuesday, what would I want covered? Usually it's final expenses. If I have a mortgage on a home, I want that mortgage paid off. If I'm renting, I want that rent paid for a certain amount of time. I don't want them worrying about paying for the rent. If I have other outstanding debts, let's get that covered. If education is important, if I want to cover college or some type of higher education, I get that covered. Main thing for me is income replacement. I'm the one earning most of the money for our household. If I'm not here anymore, I want that income replaced, typically for 3 to 6 years. I want her to have time to grieve and figure out, okay, what's life going to look like now that my husband's not here with me? And then also things such as like a legacy or donations. Is there something dear to your heart that you would want to leave money to? Some people, they say, well, my mother died of breast cancer. I'd love to leave some money towards the breast cancer organization or whatever that is. Let's make sure we include that. Best case scenario, we never use it. We pay into it. 20 years from now, we're still here. We're still thriving. It might seem like money that we've tossed, but once again, it covered us during those years. And for most people, it's let's get those years that lead up to retirement covered. Once I'm of age, which is typically 59 and a half, now I have access to my different retirement accounts. I'll use my parents as an example. My dad, when he was 55, we had this discussion of, do you need life insurance? And he said, well, I feel like I'm getting close, but his plan was still to work at least another 10 years. That's 10 more years of contributions to his retirement funds. It's 10 more years of income to cover bills. So I said, why don't we get you covered until age 65 when you potentially want to fully retire? And then you don't have to worry or be concerned with, well, if something happens, what's going to happen to mom? She's going to have access to all those different retirement accounts. And if something does happen, she's going to have this lump sum that she can do whatever she wants with. So for me, life insurance, when you think about your financial picture, or if you look at the pyramid example and you see the financial pyramid, a lot of times life insurance is really going to be your base because we can do a great job of saving towards retirement, of paying our bills, all these different things. But if we're no longer here, a lot of times that starts to crumble because now I'm not here to put away towards retirement for the next 30 years. I'm not here to help pay the bills for the next 30 years. I really need something to leave my beneficiaries to help make that happen. Does that make sense?
But the wife would rather have the 2 million in her hand.
Well, that's more of a personal problem. He said if the wife would rather have the money in her hand than have him here, yes, I can't help with that. Yes. So if you're of the mindset of, well, I would rather pay into something and get something no matter what, rather than pay in for 20 years and then either need to get another life insurance policy or just be out those premiums for 20 years, there is what's called permanent insurance. And that is meant to stay in place until whenever you pass, whether that's at age 70, 80, 90, 100, whenever that is. That is something that we can talk about as well. In terms of premium-wise, it's going to be more expensive because we're trying to insure ourselves for a much longer period of time. Whereas term insurance, the thought is, well, let's just get me covered for these years where I'm putting money away and saving. Once I reach retirement age, I have access to those other accounts. So, questions we should be asking: do I have any? Does your work offer it? Some people I've met with didn't even know that their work offered life insurance, that they had life insurance. Yeah, a lot of times, sometimes you'll have a base policy and they don't know that for an extra $4 a month, they could have an extra $150,000 added to that. Spend the $4 a month. Work policies or group policies, they're usually on the cheap side. Definitely take advantage of those. The problem with just work policies are, once again, worst case scenario. Well, if something happens to me health-wise and I'm unable to work for my employer, that life insurance doesn't go with me. If I'm no longer working for said employer, I'm uninsured. So now if something health-wise comes up, I can't work, and then I end up passing, well, now nobody gets anything. I'm completely uninsured. And that's where a personal policy comes into place, is, well, hey, if something happens to me while I'm at work, it's cheap, I'm taking advantage of that, but worst case scenario, I want to know that if something happens health-wise and I'm unable to work and then I pass, my people are still going to be taken care of. My wife and niece are going to be just fine. So for me, I have personal policies in place. I have my work policy I take advantage of. You should be doing the same, and if you've never had the opportunity to sit down and talk to somebody about life insurance, what does that look like? What is the underwriting, what does that whole process look like? What can I realistically expect to pay in premiums? I would be more than happy to kind of go through that, help you look into it. If we come to a level of coverage that you're wanting to, we can see what it's going to realistically be premium-wise. We can go through the whole process, and then at the end of that, if you decide you want to put it in place, awesome. If you decide against it, that's fine too. It's just knowing that you can do it. Does it make sense? Does it make sense?
Put more money aside.
I have already life insurance with my lawyer and separate.
Oh, personal?
Okay, so the other thing that people tend to ask in terms of life insurance is, okay, it's for a death benefit. Are there other uses for it? The answer is, once again, absolutely. There are some cool ways you can utilize life insurance for above and beyond just a death benefit. Is it going to be more expensive? Yes. Is it typically for people who are earning a significant income? Yes. Does it mean it's only for them? No. So if you're curious about those things, just want to have a discussion. Once again, happy to sit down and run through those things with you. Okay. Next item. Any questions on that? Any other further questions?
Just like an example for this traditional life insurance or
For like a term?
yeah.
So,
Term.
Which
for like a permanent?
Yeah, permanent.
Which insurance pays itself?
So
Like after 10 years of
You can get something. So
Yes.
for example, how much like
that's all going to depend on what you want to get out of it. That's the hard part is people say, well, what if I want... So for example, I have a client who's putting a large sum of money each year in. Now I'm talking about 30,000 plus into this account. The reason being is in retirement, his plan is to take that as additional income while still having the death benefit, right? So he's using it as another investment vehicle. That's going to be a lot different than somebody who says, well, I want to put $1,000 a month, so $12,000 a year. There's potential that you could take some type of income from it, or is it more for, we just want to make sure that I'm covered if I were to pass away at 95, I want my wife to still get something from it. So it's going to be different whether we want to utilize it as an investment or if we're still just utilizing it as for a death benefit.
But I want it to stop, though, like if I'm paying $500 a month,
Sure.
I want to pay for 5 years,
Yep.
then still have the
Death benefit?
benefit.
Sure.
plus
That's
the
possible too.
Plus the dividend that created,
Yes.
and I don't pay after 5 years, it starts paying itself and accumulate, like an investment. Right?
Yes. So I can say for somebody on the younger side of investing, that's going to look a lot different than somebody who's, say, 55 and wants to now start the policy. They're going to have to put a lot more into it versus somebody who's 35. Well, if we start doing it now, it's going to have time to build up that cash value and then eventually just pay for itself because you have what's called the cost of insurance, and that's what a life insurance company determines, what is this person's cost of insurance to insure them. That tends to start to rise, more rapidly as we get into the 50s and especially 60s. So if we can get in on the earlier side of things, it's going to make a big difference versus getting to do it late. But I would still say we can still look at what the numbers say. So, yes.
I was talking with a guy, as an example. He
Yeah.
has a life insurance. He was telling me, I just met him and we were talking.
Sure.
About life insurance, and he's an entrepreneur. He
Sure.
has money and stuff. And he insured his life for $1 million.
Okay.
I believe it's $1 million. And whatever he puts monthly, he can borrow that from the life insurance.
Yes.
While the life insurance still continues.
Yes.
He dies, while he just borrowed, he can borrow only the money he put.
Yes.
So he
So-
can still borrow it
So he's basically using it as his own bank, which is, yes, which is a strategy. That is something that people like to do, is utilizing the ability. And what he's essentially doing is he's taking a loan from the policy, using that money probably to fund his investments or whatever he's doing, which if you have the cash up front to open the policy, absolutely. But does that mean that everybody can necessarily do that? Not necessarily, right? So it's got to make sense numbers-wise. But if that's something you're curious about looking into, be happy to look into it for you as well. Because there's some, yes, so you have there's cool things as long as the policy doesn't lapse or end while he's still living. If he typically the way it is, if he passes while he has a loan against it, it comes off of the death benefit, depending. Okay, if that policy were to, let's just say it blows up in his face, he borrows too much, the economy does not so great for 4 or 5 years, and suddenly his value is zero. Well, unless he puts a bunch more money into it to keep it alive, if that policy lapses, well, now that money he took out is taxable income. He's going to be in a pickle tax-wise. So there's different cool ways that you can utilize life insurance. Exactly. It's basically a way to have tax-free, yes. So depending on the policy, there might be an interest rate attached to it. So it might be like a 2% interest rate while has that loan, borrowing against the policy, but he's paying it back into the policy. So it's just one of the cool ways that you can utilize life insurance. Yes. Great questions. Any other questions? Yes.
I have a question about 401k.
Okay.
When the time comes to liquidate my 401k and the market is down,
Yes.
am I forced to leave with the loss?
Great question. It really depends on the plan. Part of the plan document decides whether if you leave as an employer, whether you have to take that money and move it. Sometimes you have I believe it's typically roughly 90 days of separation of service to then move that to a different account. If that's the case according to the plan document, then yes, unfortunately you have to move it. However, if we're moving it to another investment vehicle, we're not cementing in any type of loss. We're just taking it from the investments in your 401k, moving it to investments in an IRA. And as long as we don't take that money as income, we can wait out. It'd be up to you whether you wanted to take it as income, but wait for the market to come back. And that way we're not cementing in any type of loss, which it sounds like that's the concern there is, well, I don't want to take money out while the market's down, right? I'd rather keep it there. So once again, as long as we move it to another qualified account, it shouldn't be an issue.
And is the tax rate is paid? Let's say from now, I'm 35, like when I retire maybe 65, 63.
Tax rates could change. So that is the risk that you run with a pre-tax savings, is I'm not paying taxes now, I'm going to have to pay them in the future. So if that's a concern of yours, that's where the Roth becomes more advantageous, because we're paying our taxes today, and then regardless if taxes are way higher in retirement, we've already paid that piece on Roth contributions. So if you have Roth available in your 401k, it might make sense to do still partially a pre-tax contribution and then also partially a Roth contribution, just so that you're kind of negating that fact that taxes could go up. Will they? That's anybody's best guess. Who knows when we get that far in the future. So yeah, that would be the way of negating that is by utilizing part of your plan, whether it's in a Roth IRA or if you have the Roth option in your 401k, make sure that for a piece of it, we're paying our taxes today. Does that make sense? Any other questions?
You're saying, so every plan you have, like, it's always based on the market, so what if I want some plan that it's not about the market?
Yeah.
But hey, you're giving me like 3%, 4%, whatever it is.
Sure.
Forget the market.
Sure.
If the market loses, it's not my money.
Sure. That would be what would be considered more of like a fixed annuity, where they're guaranteeing you a fixed return. Regardless if the market goes up, goes down, stays flat, you're earning a fixed return on that. Could be in the form of a fixed annuity, could be in the form of, depending on if it's qualified for like a CD through a bank. So there's options for that. It's just really, what are your goals for that money? Are we okay with earning a 2% for the next 5 years, or do we want it more attached to the market, where if the market goes up 10% a year, we're getting that full 10%, and then also it could go down. So one of the options now, which has become more competitive and more appealing, is, well, what if I had the ability to earn a return if the market goes up? So hypothetically, market goes up 10%, I get the full 10. Market goes down 10%, I don't lose anything, right? So that would be what's called a structured investment option. And the way they do that is they say, well, if the market goes up 12%, you keep 10, we're taking 2. And then if the market goes down 12%, we'll absorb the first 10, you lose 2. So it's kind of a way of hedging your bets of, hey, if the market goes up, I'm still earning a return on my money. And if it goes down, I'm either going to lose nothing or I'm going to lose less. If that's something that you're interested in, those options do exist, and they're becoming more and more popular. And Equitable, my company, has a product that does just that. Yeah, go
I
ahead.
don't need to put my eggs in one basket.
I mean, you're talking about like diversifying. We want to make sure that within,
Here and there.
yes, it just has to make sense for what your goals are, right? So if your goals are to be as aggressive as possible, let's use things that are more tied to the market and grow that money as much as we can, assuming that your risk tolerance allows, that's what you want. If it's more, I want to focus on conserving what I have and making sure that it lasts, well, let's look at options that are more conservative and maybe kick out some type of guarantee so that you don't have to be worried about running out of money long-term in retirement. Does that answer your question?
Fixed annuities, sometimes they offer, like, now, I attended a seminar, they're offering 41% upfront on your investment.
So the thing about fixed annuities is there's so many different investment firms that offer so many different options in terms of, some of them offer bonuses for staying in for so long, some of them offer guarantees. So that's where it's figuring out, okay, what makes most sense for you, and does it make sense, and is that something you want to sign on the dotted line and be committed to, or are there things about that that maybe we have to take a second look at? Once again, well, what if we need access to more money than just that fixed amount? Do we have something that's giving us guaranteed money and then still a piece that's maybe tied to the market or more liquid, so that if something does come up, now we're able to cash flow that versus, well, I still only have my fixed income payment, and now it's going to have to go towards some type of debt, which isn't ideal. So it's, once again, it's making sure whatever your goals are, that we put you in something, some type of platform that's going to accomplish that goal and make sense and is in your best interest versus just, it sounds great, so we're going to run with it. It's got to make sense. And there's a lot of different options out there. And if you want to run through some of those options, that's what I'm here for. Make sense? Okay. Any other questions?
Best thing to do is give it to your wife.
He said the best thing to do is give it to your wife. If that's the case, I will gladly meet with your wife and help her decide what to do with it as well. Last thing before I let you guys have the rest of your night, because we're at time. Yes, go ahead.
So just from your own experience.
Yes.
What's one financial mistake people make most, and how can we avoid it?
One financial mistake people make most. I would say it's by not reviewing what they're doing. So a lot of people start something, which is great. They start something, let's just say when they're 22, 23, right out of college, they start doing something and they continue doing that exact same thing. So let's just say they take 5% of their paycheck, they put it into an employer-sponsored plan, and they do that for 10, 15 years. Well, a lot changes over life. I know the person I was 10 years ago is completely different than now. I wouldn't have, there's certain parts of my life that I would have had no idea where it's going to, that was going to be or that was going to happen. So by actively meeting with somebody and just reviewing, okay, does contributing to that account make sense, or do we need to increase that contribution? Has your income gone up significantly? You were making $50,000 when you started doing that, $40,000. Now you're making 70, but you're still doing the same amount. Should we be, deferring some of that? You're now in a dual income household. Both people are working. Your income's gone up significantly, but we're getting killed on taxes because we haven't reviewed and, seen are there any changes we need to make. So I would say by consistently reviewing, and then as life changes, by kind of accommodating those changes and making sure we're doing what's in our, what's best for us, especially long term. That would probably be, in doing it. Does that answer your question? If you're in this boat, by any chance of, I've got a piece here, piece there. Over the years, I've had an employer here, I've got a 401k, I've got an IRA, I've got all these pieces, Jesse. I'd love to just sit down and see what would make sense in terms of maybe consolidating, or at least make sure those pieces are doing what they should be doing. Once again, I'd be more than happy to sit down with you. It kind of goes without saying, but there is such a thing as advisor-client privileges, kind of like doctor-patient privileges. I work with a lot of people, and now I'm starting to work with their daughters and sons because they've referred me to them, which is an honor. So it's a very high honor for somebody to say, hey, you've done right by me, now work with my kids. Just know that I'm not talking about parent situation with kids and vice versa. Whatever we talk about in our meetings stays between the two of us in our meetings. So you don't have to worry about, well, is he going to go telling my business, to other people? Absolutely not. I just want to make sure that you guys are being taken care of and you know the options that are available to you, and that you're able to, thrive and be generous in retirement, because that's my goal. Make sense? We're now at time, probably over time. Any last questions before I leave?
Are you leaving right away?
I will stick around for a few minutes if you want to have a private conversation in the back. I did leave all of my contact info in those packets. If you feel like you're all set for now, that's great. If in the future it turns out you have questions, give me a call. Shoot me an email. Say, hey, I want 15 minutes of your time, half hour of your time, hour of your time. I'll gladly meet you for a cup of coffee. I can meet you at your home. I can meet you wherever works best for you, wherever you're most comfortable. A lot of people say, I feel like I'm okay. Well, now at least you have a go-to person in the future. Let them know, hey, you spoke a few years ago. I'd love to sit back down and pick your brain. Love to meet with you. Other question I get asked a lot, is there any cost to sitting down? The answer is no, right? I consider that value added. So for an hour of my time, I've sat down with Saeed a couple times just over coffee to talk. That's how he came to ask me, hey, would you come speak for a few minutes? I enjoy that. I'm a people person, so I enjoy that. So I'd love to get coffee with you, just talk, whether it's about business or if you have whatever. I thrive off of that, so. So depending, another good question. So it all depends on what we end up utilizing. So like a fixed annuity, if you do utilize a fixed annuity, that typically comes with some type of upfront commission. Doesn't come out of your pocket. That would be my company saying, hey, Jesse, you just brought this lump sum of money to us, so I'm going to pay you a commission for bringing us that money, right? That's going to be different than somebody who says, hey, I want to put $200 a pay into a Roth IRA. Well, now we're buying individual mutual funds that typically comes with a fee. Right? So it all depends on what we're utilizing and making sure you understand that. So for my goal is always bring some options to the table. If they sound good, make sure you understand what it is that we're utilizing, get any questions answered, and that you feel comfortable moving forward, because the last thing I want is you to have buyer's remorse. So know exactly what you're getting into and why we're doing it, and be comfortable moving forward. And then if things change in the future, we can always cross that bridge when we come to it. So
you don't make money off of us, off of your company, because we're putting money into it.
yeah, it all depends on what you're utilizing. So the type of a platform we're utilizing, whether it's a lump sum of money coming over or whether we're contributing monthly, it really all depends. But I always make sure and cover that with clients before we actually start moving money so that they understand and know exactly what they're getting into. So, any questions? Anything? No.
I actually can, when you start with life insurance.
Oh, okay.
But, yeah,
So her husband gonna take
I
it.
was telling
Okay.
he should give it to her, to his wife. But 200 is not that much. It's 1,000 come about 200.
It's 480,000. You rather have it or pay it?
In life insurance,
If you guys come up with any other questions, I'll hang out in the back for a few minutes. Feel free to come up, shake my hand. I'd love to meet you individually. And then I will leave some packets, so if there's anybody who's joining via video, if you want to come in, grab a packet. If you come up with your other questions, just want to reach out, be more than happy to meet with anybody that's joining virtually as well, just to make sure you get your questions answered. So thank you again, Saeed, for setting this up. I appreciate you as a person, as a new friend, and I look forward to meeting you guys after this. So thank you.